afternoon, everyone. Welcome to our market update with Rick Sharga. Special guest Alan Jarson from RCN Capital.
Thanks, Jeff. Thanks, Rick. Great to be here today with you guys.
So, folks, as always, we're going to get into the data. We're going to get into the weeds with what's happening in all things residential, single-family housing. We'll touch on multi a little bit. Today, we finished out 2023, and we've got the data, and we're going to dive into the numbers today. So, Rick, existing home sales ended 2023 just under 4 million units, lowest in 25 years. Has the market finally bottomed out? I mean, the question is 4 million going to be the new baseline going into this year, or are we going to start to see an uptick?
I think we'll start to see an uptick. I believe we've bottomed out in 2023 and are likely to see home sales start to come back a little bit in 2024. I don't expect we're going to have a huge, robust home sales market this year, simply because there's not enough inventory and because affordability is an issue for a lot of prospective buyers. But we do have a really strong tailwind supporting the housing market, Jeff. We have about 35 million young adults between the ages of 25 and 34. They're not all living at home with mom and dad, but some of them are in my house. But most of them would like to become homeowners in the near future. The numbers last year were abnormally low for a country with our population and the economy being as strong as it is. So we're seeing inventory levels creep up a little bit. We're seeing a lot of pent-up buying activity and demand. I don't think we get back to 2022 levels this year, but maybe we see 4.5 million existing home sales. So we're at least heading back in the right direction.
So, Alan, you work closely with all of RCN's correspondent partners.
Right.
What are you hearing from them as to what Rick just said, which is we're at 4 million. Are they buying? Are they selling? What are they thinking about?
Yeah, so right now, one of the biggest concerns I'm hearing from my lender partners is the inventory issue, right? So, you got a lot of flippers out there that are out there looking, they want to buy at market or below. To keep that return on investment number where they need it to be. But they're not finding the inventory. When they do find the inventory, there are still some bidding wars going on, so they're buying over market. Where do you see those inventory levels going in 2024? Are we going to increase those inventory levels to the point where maybe some of the sales prices stabilize a little bit, and maybe there's not such a bidding war on all these properties?
Well, we're seeing inventory level increase over last year. So if you look at the inventory of existing homes available for sale today, according to Altos Research, we're looking at about 500,000 properties available for sale. That sounds like a lot. It's up about 20% from a year ago, but it's about half of where we were in 2019. And it's about half of where we would like to be in a normal market where you had enough inventory for the people looking to buy. We're seeing new listing activity that's going up a little bit. We're seeing about a 15% increase in new listings on a year-over-year basis. Most recent data I've seen from Altos Research is there were about 60,000 new listings in early March. And really what we're seeing with the inventory numbers overall is once a property is listed, it's just taking a little longer to sell. So it's not like we're getting a ton of new listings. What does get listed is simply staying on the market a little bit longer. It's probably important to point out that, despite everybody's efforts to get people to consider listing their homes, about 2/3 of homeowners with a mortgage have a mortgage rate of 4% or lower. About 90% have a mortgage rate of 6% or lower. Particularly for the people below 4%, the math just doesn't work in their favor to have them list a property for sale and then buy a new house with a mortgage of 7%. So until we kind of see the mortgage rates come down a little bit, it's hard to foresee a scenario where we have a huge increase in properties being listed for sale. There will always be some properties listed for sale. There are always going to be births and deaths and divorces and marriages and job losses and new jobs that require transfers. So there will always be some number of people putting their properties for sale on the market. But I believe in 2024, it's going to be mostly people who feel like they need to sell as opposed to people who are just thinking about selling.
Yeah, that's super interesting. You touched on the cohort of folks that are coming into the marketplace, and it's really just a numbers game, right? Like a certain number of births happened a certain number of years ago, and there's no getting around that. How has that affected the marketplace in years past?
Well, what we've seen is that the supply is just dwarfed by the demand. The numbers are all over the place. I've seen estimates ranging from a shortage of 2 million homes to a shortage of 7 million homes. Just depends on whose numbers you want to believe, but it's millions of homes. And when you have that much more demand than you have supply, it jacks prices up. And the only reason prices aren't going up faster than they're going up right now is because it's so expensive to finance the purchase of a property. But that's really what happens. And one of the other things that we're seeing, Jeff, is a continued migration from high cost coastal areas into the Midwest, into the South, into the Southeast, into more affordable markets. So you're really seeing kind of a flex, if you will, in those supply and demand curves based on geographies. I think I've told you this story before, but just, a household anecdote. I have an adult son who's a teacher. His fiance is a lawyer. They're getting married in September, and they've been asking me what state they need to move to so they can afford to buy a house. Because with the median price of a home in California being about $800,000, they know it's not here. And I suspect those conversations are happening in households across the country.
Yeah, super interesting.
You're talking about the supply piece of this, right? So, last year, inventory was way down, and we saw an increase in new home sales, right? So there was contractors out there building homes, and then recent data is showing us today that in January that actually declined. Can you talk a little bit about why that might have declined, or if that's something we're going to see throughout 2024?
I am so glad you brought that up because this is another media head fake. So yes, you saw home starts decline, but what they didn't tell you is that the decline was caused by a 39% drop in multifamily starts. We're coming off a record year in terms of multifamily units being built. Estimates say that somewhere between a million and 1.1 million apartment units are going to come online from about the middle part of 23 to the middle part of 24. And we just don't need a lot more apartments being built right now. If you actually look at single family owner occupied housing starts, they're up about 8% year over year. And so that's a good thing. We also saw housing permits for single family residential units up both month over month and year over year. So the builders are bullish on the future. But the builders, particularly the larger public builders, are still kind of licking their wounds from the Great Recession when they kept building even after the market turned and got caught with just a massive amount of oversupply. So they're going to be very judicious about how quickly they bring properties to market, but they are going to bring more properties to market this year than last year. Last year, they sold about 660,000 units. I would not be surprised if we see that number go over 700,000 this year. But there are still some things that keep them from building more and more quickly. Labor shortages, there's still a little bit of a supply chain disruption in place. And candidly, states like California, they make it really difficult to even get a project started. So there are still some headwinds facing the builders, or I believe they'd be building more and bringing those properties to market.
So you mentioned the statistics there and sort of how it all works. I think for our audience today, now would be a great time for you to share with the folks how the statistics work. When they hear starts, right, like new housing starts, how are the statistics put together multi versus single family? Is it 1-to-1? Or I think this would really benefit the audience, Rick.
So the Census Bureau reports on a lot on new homes, and they count a housing start as a housing start, whether it's for a multifamily unit with 100 units or it's a single family, 3-bedroom, 2-bath, 1,500 square foot house.
So not to interrupt, but they're treating 100 units as one, or are they treating them as 100? They're just treating them as one.
Treating them as one.
All right. Well, that doesn't pass the common sense test.
Well, a lot of statistical stuff doesn't pass the common sense test, especially when the government gets involved. But you are talking about kind of apples to oranges here. You're absolutely right. Again, the bottom line is that what our audience probably needs to be most focused on is what we're seeing in terms of single family starts. And there are separate statistics that look at the units involved in a multifamily construction piece. So there are different data sets that you look at for those different criteria. But bottom line right now is that we're coming off an all-time high in the number of apartment units being built to get back down to more normal levels because we simply don't have enough demand for that kind of continued supply. Vacancy rates in apartments were at all-time lows a couple of years ago. We had occupancy rates of 97, 98%. Now they're back down to more normal levels, 90, 93, 94% occupancy rates. And from what I hear, similar numbers on the single family side as well. But what I think is important for investors looking at the single family rental units is that a lot of the people who want to buy a house really want to be in a house. They don't want to be in an apartment. And so, again, if you can find the inventory and make it available for rental, particularly in a period of time where people are having trouble putting together the down payment they need or might not be able to afford a mortgage rate on a purchase, you're looking at somebody who's probably a willing, ready, and able renter for that kind of property.
Interesting.
So going back to the rental piece, right now, I mean, rates are, they're as high as this generation's seen, right? So where do you see a lot of these new home buyers and just people out there looking for inventory? They're deciding to just rent, right? So they want to go in, they want to lease. And this is great for our long-term investors, right, that are out there that have those single-family homes and apartment complexes. Where do you see those lease rates going? Does it make sense to go out and lease? Because those lease prices they've been through the roof and they just seem to be climbing year over year. Does it make sense for them to lease with what it's costing to actually rent today compared to what it's going to cost to purchase a home with that kind of rate and mortgage?
There's a certain segment of the population that candidly just prefers to rent rather than buy because they want the flexibility of being able to move if they need to, and not get locked in like they've seen some other folks get locked in for whatever reason to a longer term financial commitment. Does it make sense for that person to rent rather than to buy a property in today's market? It is more cost effective in just about every metropolitan area, every MSA across the country to rent than to buy. And that wasn't the case a couple of years ago. Now, mortgage rates don't have to fall down dramatically to reverse that, given today's rental costs. But if we see mortgage rates get down below 6% in the next year into the mid fives, my guess is that in a lot of those markets, it will suddenly be more cost effective to have a mortgage than it will be to pay those market rental rates. As home prices have gone up, there's a higher financial barrier to entry, particularly for first-time buyers who have to save up for a down payment, are trying to put enough of a down payment on to get a favorable mortgage rate. And so in a lot of cases, they simply don't have the cash they need to enter into a sales agreement and are better off renting, at least in the short term.
Interesting. Some of the stats that we saw at the end of 23 is first-time buyers composing almost 33%. Investors, 30% of all the transactions. I mean, these are some interesting numbers, Rick.
Well, this is part of the reason that we're seeing a really high percentage of first-time buyers and a really high percentage of investors in the residential sales market is because most homeowners today are locked into their homes because they have such low mortgage rates. If you're sitting on a 4 or 3 or 2.5% mortgage rate, you simply can't afford to sell your house and buy another one. Imagine having a 3% mortgage rate, selling your house, buying another house at exactly the same price as the one you just sold, and seeing your monthly mortgage payment more than double. Most people simply can't afford to do that. So your move-up buyer, your traditional move-up buyer, is kind of stuck in place right now. They simply can't afford to move up, trade in their low interest rate mortgage for a higher interest rate mortgage on a more expensive house. It just, the math doesn't work. So you're seeing a higher percentage of sales from people entering the market for the first time, and you're seeing a higher percentage of sales among investors who aren't going to be locked into those higher mortgage rates in the long run, particularly if they're on the fix and flip side.
Yeah, makes sense.
So maybe we should talk about prices, right? Going into this calendar year, where folks think about prices, and I've seen the prognosticators out there, right? The smart folks. I've seen everything from 2% to 8%. It's all over the map. Slanted towards investors, right? Like investors want to know, if I'm buying a property first or second quarter, am I going to see some appreciation this year? With that in mind, what are your thoughts on appreciation and maybe some of the telltale signs that investors should be looking at to think about where the prices are going to go this year?
Yeah, that's a great question. So from my perspective, the most likely scenario is that mortgage rates will go down gradually, but steadily over the course of the year. We won't see a significant dip in mortgage rates, I don't believe, until the Federal Reserve issues its first rate cut on the Fed funds rate, which I don't expect to happen until June. So mortgage rates for the first and second quarter kind of going to bounce around within a narrow band between maybe 6.75 and 7.25%. Some weeks higher than others, some weeks lower than others. Once mortgage rates start to go down even slightly, we'll see more buyers come to the market quickly. And those buyers will be coming to market and competing for the limited inventory of properties available for sale. That's bound to increase prices across the country. If I had to give you a number today, I would say nationally, we're likely to see prices go up between 3 and 5% between now and the end of the year. Some markets are going to be higher, some markets are going to be lower. So what I would really be telling investors is understand what's going on in your local market. If you're in Austin or if you're in Seattle, you're probably seeing prices continue to go down a little bit year over year. If you're in Pensacola or Raleigh or Nashville, you're probably seeing prices go up a little bit more year over year. So nationally, I do expect to see prices go up, particularly as mortgage rates come down. But regionally, you really need to be a local market expert and look at things like population growth, job growth, wage growth. If you have positive numbers in all three of those, you're very likely to see home sales increase and home prices go up.
Yeah, we've seen that just in the last few years with inflation, the amount of people that are leaving certain MSAs throughout the country, you know, the New Yorks, the Californias, leaving to go to a more affordable area, you know, within the US, going to Florida, Texas, whatever the case may be. How impactful do you think that is when it comes to our investors? Are we going to see a huge decline in those areas of these folks being able to go in and truly make money in these areas on a flip basis, or are they going to have to get real granular down to municipalities Because, California's huge, and you look at New York, Long Island's different than New York City, that's different than upstate New York, right? There's probably 5 different MSAs right there. So how granular do you think they are going to need to get to really understand what they're going to do in these markets?
If you're a fix and flip investor and you're not looking at the most localized information you can get your hands on, you're making a critical mistake. I'd be crazy to sit here and say you can buy a property anywhere in Tennessee and make a profit on it. I don't know that to be the case. What's going on in your neighborhood is going to be different than somewhere else in the same zip code. So you really have to be paying attention to that. We talk about national numbers, we talk about regional numbers because that's what we can get our hands on. We talked about home sales being down last year. There were still 4 million sales that were transacted. For us to be sitting here and analyzing 4 million sales and getting into that level of data, that's, you'd need an artificial intelligence application just to try and get some sense out of that. So if I'm a fix and flip investor, I'm becoming a local market expert and really understanding the neighborhood that I'm looking at a property in, and how it relates to other neighborhoods, what the most recent sales comps are. Because to your point, a sale in Buffalo, New York is very different than a sale in Long Island, New York. And I can tell you, even in Southern California, where I'm speaking to you from today, very, very different scenario in Los Angeles and Orange and San Diego and Riverside and San Bernardino counties. So you really do need to be digging into local market activity in order to understand what the likelihood of success is for your investment.
Yeah, I think that's really important for our investors to know, because we are starting to see an uptick in more rehabbers getting back out into the market. And, it does concern me that maybe they don't know that market as specifically as they should. To make sure that, each project, you want everybody to win, right? So you want every project to be a good one, and I think it's important that you do that due diligence up front. Make sure you know your markets, even if you have to move over a town, right? And get out of one town or wait and see, but go to another town, whatever the case may be. But
according to the survey results we've seen from investors who participated in the RCN Investor Sentiment Survey, the overwhelming majority, something like 80%, if I'm not mistaken, do invest close to home. They're either in the same city where they live, other cities within the state, or somewhere in that state. And so I think we see that from fix and flip investors historically. The good news, nationally speaking, is that we're starting to see gross margins improve for flippers. If you look at just the price they bought the property for versus the price they're selling it for, we've had, I think, 3 consecutive quarters now where those gross profits have improved. So I think the trend line is going in the right direction. But it's always important to understand your local market as a flipper. It's probably never been more important than it is today, just because the margins are razor thin.
all right.
So that's a great point about getting granular and really getting in the weeds in your own marketplace. As investors, especially smaller investors that may not have access to institutional data, is there some easy ways that investors can dig into the numbers with internet-based applications that may give them a great snapshot of what's happening in their local area, ideally for free? Do those resources exist, Rick?
Actually, it's surprising how much data you can pull, how much trend information you can pull from free websites like Zillow and Realtor.com. I know Homes.com is spending a lot of money updating their website as well, and probably a ton of information available there. But yeah, there's trending information on inventory levels, on prices, on sales volume, on other demographic information that you can pull right off those sites, and it's not that complicated to dig into that data. But there are also things like the Department of Labor has a free website. The Census Bureau has a free website. The Federal Reserve Bank of St. Louis has a free website, where you can go and use their search functions to find a lot of this information on a very localized market basis. So the data is out there. And it's free in most cases. It's just a question of spending some time to learn how to use some of these tools that are out there and available.
That's interesting. One of the things that, and this goes back to what we were talking about earlier, is following the migration trends, because generally where people are moving, generally the jobs are there and generally they're going to need housing. Is there good data points to follow the sort of migration trends?
If you're looking for migration trend data, it's probably available on the Census Bureau site. Personally, I have been following organizations like Freddie Mac, the Mortgage Bankers Association, and a few others who compile that kind of raw data and turn it into reports. That's a little more challenging because in a lot of cases that data lags a bit. But there are third party research organizations that do track some of that stuff and make it available for people to use. One of the things, just being practical about this, most small to mid-sized investors are not living in New York looking to buy properties in Montana and Wyoming. And so what's really important is to pay attention to what you're seeing locally, where you live and where you're more likely to be doing most of your investing. And news outlets are a great way to see that. Just looking at county websites can often get you the kind of population and job information that you might be looking for. And as silly as this sounds, simply doing a Google search for job growth or population growth in an area you're interested in will turn up an amazing amount of free data. So, don't ignore the obvious tools that are there to start your research and find sites that maybe I'm not even aware of.
Well, I was thinking about, the affordability of some of these sites that really dig into a lot more aspects of those local areas where you can get properties, off market. You can look at so much data around these zip codes and areas. And these sites are getting way more and more affordable every day. I know RCN, we partnered with one of those sites and they do a great job. There's just so much information that you can gather to make sure that you're getting into a good project, that maybe you can get some of these properties off market and get it below market. So there's a lot of opportunity out there. Rick, I think the population growth, the job growth and things of that nature, it's a really great starting point to get a general idea of where you want to invest and where you want to start doing your flips. But I do think it's important that we dig a little bit deeper to understand, what's out there. Where can I find those properties off market? Because we are seeing, that flipping market is starting to come back. It's really starting to ramp up again.
It sure is. Sure is.
And you want these investors to win every time. And I don't know that that's 100% accurate, but you want to win is more often than you lose, right? And the more information you have, knowledge is power. It's going to really help you be successful.
Yeah, without a doubt. Certainly REI Dealmaster, without a doubt, is something that folks have been looking at. It's a subscription-based service, but the amount of data that is available is...
I couldn't even go into it because there's so much.
It blows your mind how much is there. And for more seasoned investors, and when I say seasoned, you got a couple under your belt. The subscription is nominal, and if this is how you're going to make your living, that's the kind of data that you're looking for, without a doubt.
Worth every penny.
There are other subscription services, companies like Property Radar, that also include a lot of information on properties in foreclosure, and have tools that people can use to analyze the value of those properties. There's a bunch of those sites that are out there for investors. Um, but it's one of the things that we talked about a little earlier is people who need to sell versus people who might be considering selling. And among those who need to sell are people who are in financial distress. You can have a lot of equity in your house and still be in foreclosure because you lost a job and missed a couple months payment. And so getting to lists of borrowers who are in the early stages of foreclosure, um, who are trying to sell that property before an auction takes place, is one place that investors can look. You can work with the local realtor who has access to some of that data. You can work with a local title agent who has access to some of that data and could get it for you for free, basically. And there are hidden features on some of the free sites we talked about before, maybe not purposely hidden, but Zillow, for example, has free foreclosure information on the website. You just have to dig into Zillow to figure out exactly where it is, but it's in there if you look for it. So there are places you can look to find those properties that are either off market or not even ready to go off market yet, but they're going to be coming because the homeowner's in financial disarray.
So maybe we take a minute to talk about geography. We've certainly touched on it. New York is different than California. California different than Florida. But kind of broad strokes, Rick, what are you seeing from an overall single-family housing marketplace across the U.S.? You touched on Austin having some struggles. Maybe we'll just spend a couple of minutes talking about areas where you're seeing some geographies have some struggles and other areas where things are maybe not quite off to the races, but getting there.
So there are markets that are in trouble for a couple of reasons, and we're seeing prices decline. There are cases where prices just over accelerated during the pandemic to ridiculous levels. Boise, Idaho is one where prices went up 47% in 1 year. That's just not sustainable. So we've seen a bit of a clawback in pricing in markets like Boise, like Salt Lake and St. George's in Utah, and like Austin. Those were probably the poster children for those kind of rapid price increases. We saw a little bit of a decline in markets like Las Vegas and Phoenix, but those markets have recovered and are doing a little bit better right now. We've seen areas in the Pacific Northwest like Seattle and Portland where prices have flattened, and in the case of Seattle are actually slightly negative year over year. Interesting that we talked about some of the markets where we're seeing populations decline, but we haven't seen prices decline yet. You're looking at markets in California like San Francisco and Los Angeles, New York City. You're looking at Chicago, where there is a bit of a migration out, but apparently housing was in such short supply there that it hasn't had the kind of impact you'd think about on prices. We've seen a migration, interestingly, out of the Miami area in South Florida. But the rest of the state is just going gangbusters. So people are moving into Florida from out of state and moving north in Florida from the southern part of the state. But if you're going to track general market patterns, I think we'd be looking at other parts of Texas being very strong. We'd be looking at states in the southeast like the Carolinas, like Tennessee, doing very, very well. And in the last few months, we've started to see Midwestern states pick up a little bit. If you really want to look at a market that everybody keeps overlooking, it's probably Columbus, Ohio, which for several years has surprisingly been one of the strongest real estate markets in the country and is actually poised for future growth because of future business development. Intel has announced they're going to create a fab plant not too far outside of Columbus. And when you couple that with the fact that Ohio State University is there, there's a heavy presence of medical and healthcare employers in the area. It continues to be one of those under the radar, unheralded markets that's doing very, very well. And there are other markets like that across the country, but those are some that come to mind.
Maybe we shift and talk a little bit about our friends in the new construction business. Certainly, they continue to perform well. Much of that is being driven I would say by their ability to buy down rates, which is making new homes affordable. Maybe let's touch on that for a minute, Rick.
So new home sales have been very strong for a couple fairly obvious reasons. The most obvious reason most people don't talk about is that they're available. If you look at existing home availability, it's half of what it would normally be. New home availability is actually back to pre-pandemic levels. So there's about a 7-month supply of new homes available for sale today compared to 2.5 or 3 month supply of existing homes. But they're available and people are looking at them. You mentioned another very compelling reason, which is builders are coming to closing with sometimes tens of thousands of dollars and paying down mortgage rates. I recently spoke to a group in Denver, and as I was driving to the event, I saw a local builder advertising 4.9% mortgage rates, which makes a very compelling argument for a potential buyer. And the other is that new home prices are actually down 15% from peak. So while existing home prices are up 6.5% year over year, new home prices are actually down a little bit, not because builders are discounting existing inventory, but because they're building slightly smaller homes. They're building homes with somewhat less expensive fixtures, trying to adjust pricing to account for the new market reality in terms of higher finance costs. So builders have really adjusted pretty well to these changing market dynamics. And as a result of that, we saw new home sales increase in 2023. And I believe we'll see another pretty significant increase in the number of new homes sold in 2024.
Interesting. Well, I'm going to wrap it up today with the favorite question of all investors, homeowners. And you touched on the Fed reducing interest rates, right? Which would be the catalyst for the mortgage market coming in. But maybe talk a little bit about how that catalyst may or may not accelerate a reduction in interest rates that really isn't completely driven by the Fed, but the mortgage market looking 6 and 12 months in the future where we're going to be, and maybe making even a small prediction of where you think we'll be at the end of the summer for an interest rate, Rick.
Yeah, with the caveat that I almost always get mortgage forecasts wrong. As do most other people. I'm just honest enough to admit it. I do believe the most likely scenario for this year is that we will see mortgage rates pretty much stay where they are until the Federal Reserve issues its first rate cut, which isn't likely to happen now until June. At that point, when the market does get that signal from the Fed that cuts are coming and are going to be imminent, even though the federal funds rate isn't directly related to mortgage rates, I think right now the market has built in an extra point or point and a half in the usual spreads between treasury yields and mortgage rates. And we'll start to see that spread narrow back down to more normal levels. And given that, I think we get down close to, or maybe optimistically, even slightly below 6% mortgage rates for highly qualified borrowers by the end of this year. That said, I don't think we start to see a lot of existing homes listed for sale until those rates get down to 5.5% or lower, which I don't think probably happens until sometime in 2025.
Well, he said it. We're going below 6 by the end of the year, Alan.
I already wrote it down.
Is that what I said? Wait.
I feel like this is being recorded.
I love it. So well done, Rick. Thanks for joining us, and thank you, Alan, for joining us
Thanks
today.
for having me. It was great joining you guys today.
Really enjoyed it. Thank you all.
Pleasure.
We'll see you soon.